Welcome to Concrete Conversations, the Indian real estate podcast. I'm Yash.
And I'm Akshay, and we're the hosts of the show.
In the last few years, there's been a big push to make Indian real estate more accessible to investors. We spoke about REITs in an earlier episode, but in the private sector, one investment avenue that's been gaining a lot of traction is fractional ownership.
So what is fractional ownership? How does it differ from REITs? And how does this PropTech disruptor add value for investors?
To discuss all of this and more, we have with us today Aryaman Vir, founder of MYRE Capital, a fractional ownership company. Aryaman has a background in engineering from the University of Pennsylvania and experience working on Wall Street, in private equity, and researching urban development and green growth with Nobel laureate Dr. R.K. Pachauri.
Today, he incorporates these experiences from the worlds of technology and finance into this exciting new space in Indian real estate. So get ready to learn about how you can get exposure to some of the best real estate assets in India at a fraction of the cost. So, Aryaman, thank you for giving us your time. Thank you for being a part of Concrete Conversations. How are you doing today?
Hi Akshay, doing well. Thank you for having me. It's been a very interesting platform, in fact, that I've been following. So quite excited to actually be on one of the episodes.
We're excited to have you. You know that through the introduction, the audience will know a little bit about your career and about MYRE as well. But we thought maybe we could hear it from the man himself. So why don't you give us a small summary of your career and how you ended up working in fractional ownership and founding MYRE?
Sure. So, actually the background that I sort of have is a little bit interesting. So I started by doing an engineering degree at the University of Pennsylvania in the US. During my time in engineering, what I actually like the most is the application of the technology. So in the midst of my college degree itself, I was actually experimenting with a few applications in the fintech space of technology. And coincidentally, at that point in time, I came across Anarock, and they were also setting up, their whole platform.
Right.
And I got a sort of insight into the whole PropTech space. But subsequent to that, I, of course, went back to college. I definitely finished my undergrad and master's degree. And sort of got exposure to Wall Street, through investment banking, through venture cap. So I worked in the US for a few years. However, a lot of my interest was lying on the intersection of technology, as well as finance, and of course, real estate. Now, what I like most about India is its scalability, it's the number of people, and also it's a very under-catered to market. So what I did want to always explore is something that we can offer, to the larger audience, especially in a country like India, which has a very favorable demographic for that matter. So, essentially when I moved back, when we were evaluating the whole wealth space, what we realized is that a lot of the wealth products or avenues have actually been fractionalized. Now people, you can say, don't realize that they're being fractionalized, but they are. Like even investing in the equity market is essentially like owning, fractions of a company. Buying an apartment is like, essentially owning a fraction of a building. And to that end, one of the only categories in India which hasn't been explored in the same context is commercial real estate. And that's actually where the whole journey began on how to address that problem statement.
Interesting. And then at what point did you decide that fractional ownership was the way to go?
Any startup actually runs on two parts to it. One is, of course, the problem statement, and second is there actually demand for the solution. Now, what we actually observed from day one is that a lot of people who want to invest, let's say, between 25 lakhs and 1 crore, let alone real estate, the overall investment avenues for them are very limited. So when we launched you can say, proof of concept project, we got very strong demand from a lot of our, target segment or a lot of our consumer base. So to that end, we understood that there's a need for such a product. I mean, apart from mutual funds and FDs, someone with a 25 lakh to 1 crore investment budget doesn't have very many options. In fact, the alternative space is pretty much not accessible at all to them.
Right.
So this was the problem statement, that you described, right? This was the problem statement, and then how did the solution come about?
Yeah, so when we did launch our first opportunity, in fact, it did not go so well for the first month or so. And that is because, we had a lot of interesting learnings. So the thing is that we were initially targeting HNIs. We thought they are the ones who should, be investing 25 lakhs to 1 crore. What we realized is that because they have a whole bandwidth of investment products, that's not the right segment. So when we actually switched focus to retail investors, we got a tremendous response. Asset after asset, we've been able to overfund. And we've received traction from all parts of India, let alone India. We also have received traction from, a very broad spectrum of NRIs spanning over, 20 countries. So to that end, this is a product which we've seen good demand for. However, of course, we are trying to match that with the supply. But in terms of the appetite from investors, it's definitely there.
Fantastic. So let's dive right into the meat of it. For those who don't fully understand it, who don't know what it is, Aryaman, could you give us a quick overview or a breakdown of how fractional ownership in real estate works and what value it adds for investors?
Sure. So actually, I'll just take a step back from that to address real estate and its context in India first. Traditionally inherently Indians like real estate. They like rental income. However, traditionally, what has happened is that most people have only explored, residential real estate, or have generalized all of real estate to, residential real estate. Now, the point is that commercial and residential, work very differently. The returns, the risk, both of them almost like independent asset classes.
Right.
So what we observed is that, a lot of these retail investors, or for that matter, even individual investors, do invest in residential, but not in commercial. Commercial is dominated by fund houses and, institutional investors, primarily because of the sort of lucrative return profile. Now, to understand as to why this distinction lies, it's basically to do with the whole ticket size. So residential apartments, one can purchase, starting 5 lakhs, 10 lakhs, 20 lakhs. So there's, an apartment at all budgets. Commercial real estate only starts above 20 crores, 30 crores, especially ones with MNC tenants in A-grade premises. So, to that end, even an HNI, he's not going to deploy his entire portfolio in 2 or 3 properties. So he also wants diversification.
Right.
So essentially what fractional ownership means is that we are breaking down this 30 crores, or in fact, we're finding, a multitude of like-minded investors to go out and purchase that property for them, so that they can, number one, the ticket size for each investor reduces. The return profile they're accessing is still at institutional level. They're still being able to get the 8 to 10% yields, and they are able to achieve the A+ grade asset quality. So to this end, we are trying to introduce retail investors to the whole concept of commercial real estate via this model.
Makes sense. I'm gonna simplify it a little bit just for our listeners and just ask you, take me as a case study. If I was an investor and to come to you, like, how would it work? How would I go through investing in fractional ownership through MYRE? How would it work if I came to you and said I would like to invest in real estate?
Sure. In fact, this is actually where all the tech comes in and all the simplicity of a platform comes in. So, like any other, let's say, investment product or mutual fund, someone can simply go to our website, select the property that they are interested in pursuing. Usually we, have 1 or 2 properties live at any given point in time. Even currently we have something live. If they are interested, they can of course discuss the specifics with our team, subsequent to which all documentation is done, digitally. It's all done online through the platform. They essentially transfer the funds and their rental begins from the very next day.
Okay.
Subsequent to this is actually when a lot of the value add from our end also comes into play. So we provide them an investor dashboard, real-time tracking. So they actually don't have to deal with any of the hazards involved with managing a real estate property.
Fair enough. And just to go on with this investor perspective take that we're building upon, when an investor comes to you and suppose purchases a fraction of the property, what is the procedure in terms of proof of ownership, and what tangibles do they have representing their fraction in this property, suppose?
Sure. So, we actually are using a structure which has been used extensively in the past. However, it's been used for, multiple investment avenues. So it's called private placement in a private limited. So essentially, this is an existing structure which we have adopted for the purposes of offering fractional ownership. Now, to directly address your question, what an investor would get is the equity shares or securities of private limited companies. And these private limited companies own the property. So, in short, they're owning shares of the property. And of course, these are as legit as any other equity shares of any other company. But most importantly, they're also sort of regulated. They're also sort of, overseen by the ROC.
Right. So in a lot of ways, what you've described, I can't help but draw comparisons with a product like a REIT, a real estate investment trust, where, through shareholding and equity ownership, you get a share of a rent-earning A-grade commercial property. So for investors, what is the difference between these two? And is there a trade-off involved for investors thinking about getting into this?
Sure. So, actually, this is one of the most common questions we receive. Now, the way I look at it is that it's not really fractional ownership versus REITs. They both are different investment products altogether. It's like sort of comparing a mutual fund to, let's say, like a private equity, fund.
Right.
So, to that end, what we are trying to do is, number one, give higher returns. Give a investor complete transparency into what he is investing in. So, tomorrow he knows with us that this is the property, these are the terms that I've come in at, this is my tenant. So, it's essentially like owning his own property to that extent. And what we try doing is coming under the market value, and we try to exit the property within 4 to 5 years, thereby giving an optimal return. So, in terms of our whole approach, it's more like a real estate private equity fund as opposed to a REIT. REITs, yes, have other benefits, but they also have, disadvantages for that matter. For instance, REITs, because they're publicly listed, they're susceptible to market speculation.
Right.
So, both have their own ups and downs. The way we see it is that both have to coexist. I mean, at the end of the day, REITs are looking for quality assets or aggregated quality assets for that matter. They don't want to deal with, small assets of 30, 40 crores. I mean, that's not the appetite.
Yeah.
So, to some end, we are creating a portfolio of quality assets in an organized structure so that tomorrow, let's say a REIT wants to, do a bulk purchase, then they can buy from us. So we are sort of trying to become a feeder for these REITs as opposed to compete with them.
I had another question I was going to ask, but I can't help but ask this based on what you've just said. Would this sort of mean that when it comes to investing in grade A assets, you and REITs are sort of competitors with each other in terms of getting there first or convincing whoever's built that asset to, go through you for the investment?
So, see, what REITs usually do is REITs pick up assets that are, the ticket size is upwards of 200, 250 crores.
Okay.
Your HNIs pick up assets that are usually under 25 crores.
Right.
So there's a whole middle market of about, from 50 crores to 150 crores that is under catered to. So what we are doing is we are aggregating assets in this, bracket. Tomorrow, let's say we have a portfolio of 500 or 600 crores. That sort of size will match what the appetite of many REITs are when it comes to, the quantum of funds that the deal has to be worth for them to invest their time.
Got it. And since we're talking about assets, can you tell us about the various types of assets that MYRE works with, or the various asset classes that you all work with?
Sure. So, we are actually working across the spectrum. In fact, we evaluate assets pan-India. So we are looking at industrial properties, we're looking at warehouses, office spaces, IT parks, data centers. So, pretty much anything in the yielding space,
right,
where we think that number one, we can get it in, we can get in at a good value and the property will appreciate over time. But more importantly, what we're trying to do is create a very stable rent yielding or, high yielding portfolio for our investors. So we are very conservative in our approach. We go across the spectrum, and most importantly, we are investing in each of the opportunities with our investors. So we co-invest, through and throughout.
Right.
Okay.
And just to follow up on that, since you said that, you guys look across asset classes and pan-India, in today's day and age, do you see any particular asset class that you see as, performing really well in the next 5 to 6 years in terms of both yield and price appreciation?
Sure. So, I'll state a very interesting point before addressing this question. So, traditionally, not only in India but also globally, this is a pretty common trend that when inflationary pressure is high, investors gravitate to hard assets such as gold, such as real estate for that matter.
Right.
Today, one of the biggest risks, because of the oversupply of, you can say, money, because of the printing that has gone on in COVID. Inflationary pressures are high. In India, they were on the verge of touching double digits. So, that we are seeing very strong traction towards the real estate and sort of the commodities market. We saw the gold price rocket like we've never seen before. So the thing is that real estate and gold are going to perform well in the next couple of years. And most importantly, whilst in a good market, in a bull run, everything does well. Even in the equity market, everything does well. But when an event or like a black swan event like COVID comes in, then usually what happens is the A grade assets get differentiated from the B grade ones.
Right.
The A grade ones continue to maintain their stability, and in line with that, our asset selection process has become far more stringent to be able to weed out what will remain stable and what will not.
Got it.
You were talking about your asset selection process, and it's something that we've discussed on here in previous episodes also about looking at long-term investments and in commercial real estate. So does MYRE have a specific criteria or specific parameters that you look for when selecting assets to make fractions of and pass on to investors?
Sure. So, what is very important for us is to ensure that we are able to deliver what we project. Now, when we actually come down to the asset selection process, I wouldn't say that there's some fixed formula for it. We try and understand what the current market dynamic is and what that implies for the foreseeable future. Now, just to put that into a more concrete example, our MYRE Patta offering, we picked up an office space in lockdown number 1. And just to sort of give you a throwback, lockdown 1 was when people were saying office spaces are finished forever.
Right.
So, the point is now what our hypothesis to that was that, MYRE Patta is one of the only completed townships in India. And in fact, it's one of the only ones where the residence is almost 100% occupied. So, in 450 acres, essentially a full functioning, you can say, micro city. Has a commercial development of 12 towers, and a lot of the residents work in these towers. Now, walk to work is a concept that became popular in the backdrop of the pandemic, but MYRE Patta as a township was designed on the fundamental of walk to work.
Yeah.
So all the facilities are integrated in the township itself. And to that extent, what we did notice is that we were able to achieve a very attractive price point. In fact, the seller was Edelweiss of this premises. And the reason is because everyone had cold feet regarding the prospect of office space.
Right.
Now, being able to understand the dynamics of the whole, not only the micro market, but also the demographics and the whole climate, we got insight into how this asset will perform. And, it's actually exceeded expectation. Both our tenants are not only paying rental on time, but they're also in talks with us to renew their whole contract.
That's fantastic.
And MYRE Patta, in fact, has hit a 0% vacancy rate in a post-pandemic world. So, to that end, we try and evaluate what is it that will make a development stand out.
That makes sense. Just to take a quick step back, because we talked a lot about returns on investment. Do you have any numbers or to give us a comparative in terms of the yields for commercial versus residential, or the kind of yields one should expect when investing through fractional ownership?
So, in fact, this is actually one of the most interesting parts of commercial real estate, overall. This is actually also one of the reasons that a lot of your foreign funds are attracted to commercial real estate. In fact, commercial real estate of India has been called the blue-eyed boy of private equity funds.
Right.
Now, the reason is that the returns are twofold. One is that, like a debt product, this will give you an annual yield, which is essentially your rental.
Right.
So, to put that into numbers, you can expect an 8 to 10% yield on your investment. And rentals are something which are contractually agreed upon with MNC tenants, and these are extended agreements of 9 to 15 years. So, it's as safe as you can say a corporate bond, or at least as securitized as a corporate bond for that matter. So, the yields are, to put it into context, 2x of the fixed deposit rates today.
That's interesting.
Yeah, now the other part is that most debt products are actually capped by a yield. So if you see a bond or if you see an FD, if they tell you you'll get 6% or 7% or whatever it is, then that you cannot earn higher than that. There's no scope of actually exceeding the yield. In this case, because real estate appreciates with time, not only are you getting your 8 to 10% yield, that also distributed monthly, but you also get the additional benefit of capital appreciation of the asset. So overall, when you compare it, the appreciation part is a bit like equity, where it's based on speculation and good asset selection, and the yield is something which is like debt, which is securitized and contractual.
Got it. Do you need to have, since we were talking about ticket size, do you need to have a minimum or maximum ticket size to achieve something like this?
So the thing is, real estate, I mean, if you want to enter this segment, it's not an easy segment to enter because of the overall ticket size of the asset of 30 crores plus. However, in our case, because we've reduced the minimum, so I would say the entry point through a platform such as ours would be 25 lakhs.
25 lakhs. Got it.
So, Aryaman, you mentioned, making investments like this accessible to investors by, reducing the ticket size and streamlining the process. So, where does technology and your tech stack come into this? What role is technology going to play in making services like this viable and more accessible to investors?
Sure. So, we are using technology in various aspects of this whole platform. The first and most important is the asset selection process. So right now it's not viable for us to evaluate, let's say 20 opportunities at any given time across, 10 cities. So we at any point in time are evaluating upwards of 150 opportunities in aggregate. So, what we've done is we've automated this whole assets, you can say shortlisting process. So, we generate an automated list of about 15 to 20 top assets a day through these algorithms and machine learning. But primarily what we are doing is, we are through machine learning and automation, picking up various data points, sort of projecting them onto the micro market, and essentially weeding out, the better assets. So that is one aspect of tech, and of course that is something which is an evolving process. As we aggregate more data, we'll have deeper insights. However, a part of the tech which I think investors, will interact with on a regular basis is also our investor dashboard and our whole online platform. So, as previously discussed, the whole onboarding process into any of these investment opportunities can be completed in 5 minutes, and it's all done digitally.
Right.
Now, all of that again is, fully done through automation. Your signing, your KYC, your documentation, everything is online. Your tracking of investments via the dashboard, everything is done automated. So to that end, it's a very, very investor-friendly model, which also sort of eliminates human error because, even reports, your tax reporting, your filing, everything is done automated.
That's fantastic. I think that actually blends right into our next question. Although, Yash, I think you're more the expert to ask this, but I'm going to ask it anyways. Could you tell us a little bit about the regulatory and tax environment surrounding, fractional ownership in real estate? Especially because, for example, if we compared it with REITs earlier, to invest in a REIT, I think all you need is a demat account, right? How would it work here? How would it work for fractional ownership?
Sure. So, before jumping into fractional ownership, actually, this is fractional ownership, how it's been traditionally done. So what has happened, in the past, or how HNIs invested in the past, is that they would form a consortium of friends and family and go out and invest. Now, the way this consortium would be structured is similar, how we structure our opportunities. It's only that we provide a framework to it and expertise to it.
Okay.
So overall, what we've done is we've taken, let's say old wine and put it into a new bottle. But overall, in terms of the regulation, it's essentially the same old private limited company that we float. So it's regulated by the ROC. It sort of requires us to follow the Companies Act, and there are sort of audit requirements each year as well. So we are fully compliant with the current standards. However, this being an alternative product doesn't come under the SEBI purview as of today.
Okay. Just to follow up on this, how is the income earned from a fractional ownership asset treated tax-wise? Because it's owning equity and earning from a company is different from earning rent on a property, right?
Sure. So, what we do is we actually position this as a wealth product. Now, we understand that our investors come from different, slab rates or income tax slab rates. So each of our opportunities, is sometimes structured differently. Like, for example, the Magarpatta Pune one was something that was more favorable to, people above a 30% slab rate, because what we were doing is deducting the tax within the private limited or LLP in that case,
right,
and giving post-tax income. So, effectively an investor was getting to take advantage of a lower slab rate. However, in the private limited model, what we do is pass the rental as interest to our investors, so enabling investors to optimize taxation in their hands. So we keep offering a variety of structures, primarily to be able to cater to all kinds of investors.
Makes sense. So now clearly we're seeing a lot of movement, in fractional ownership as a product and in this industry in general. So where do you see the fractional ownership market in India going over the next few years?
Sure. So, the fractional ownership entire category is very nascent in India. If you benchmark it against some of the other countries, for example, US, UK, Australia, these categories have become multi-billion dollar, you can say subcategories of commercial real estate for that matter.
Right.
So, to that end, we are, yes, a bit late to this whole trend. However, the appreciation for what is being offered and the quality of the underlying asset is actually enabling this whole category to grow exponentially fast. And it's also helped a lot that recently, we've seen a lot of interest and in fact, deployment of funds from institutional players like your Blackstone, your Brookfield. So, in the last 5 years, the amount of money they've deployed in India commercial real estate, is non-comparable to any other avenue they've deployed in.
Yeah.
Right.
So to that end, this whole category, not only fractional, but I think commercial real estate overall, over the next 5 years is going to transform. Only in India can you achieve these 8% yields in A-grade properties. If you look at Hong Kong or for that matter, US, UK, pretty much any other country, the yields over there are usually around 4 to 5%.
Right.
Aryaman, we had discussed what is essentially the definition of commercial real estate in India in one of our previous episodes. Just to do a bit of a recap, commercial real estate here, it doesn't necessarily mean office spaces, right? It means anything that helps you generate income. So it could be a hotel, it could be a homestay or some kind of a resort. It could be co-living, co-working spaces, including warehousing, including retail. So where do you see the diversification coming into fractional ownership, and how do you see fractional ownership looking at all these alternate avenues of commercial real estate?
Sure. So, I think that a fractional ownership platform, in fact, gives opportunity to investors to, let's say, diversify not only across, different asset classes of commercial real estate, like you mentioned, warehouses, data centers, like you said, co-living, but it also enables them to diversify across cities, tenants, and sort of risk appetite and things like that. Now, just to give you an example, we had a certain investor who was only interested in deploying funds in South India. So for that, for that particular investor, it becomes very convenient as opposed to having to, look across 5 cities, find a property, understand the dynamics of 5 cities. He essentially comes to our platform. We've done the work. He picks up whatever properties he likes in the cities of his liking, and essentially he can, build a yielding portfolio as opposed to having concentrated risk.
Fair enough. And, since we mentioned the previous podcast, we had also spoken about this concept of real estate as a service. And a lot of the things we've spoken about today, making investments easier, using tech to, make the entire process easier and more simplified for investors. So do you think that also plays into the concept of fractional ownership, real estate as a service?
No, absolutely. In fact, one of the major hurdles is that, commercial real estate is a very complex asset class to acquire. I mean, not only do you have the legal aspect, but you have to do, structural evaluation of the building, micro market analysis, financial analysis, multiple layers of due diligence. Now, once you even acquire the asset, you have to deal with all the operational hazards, tenant management, negotiation, exits. So, it's not something which is a very retail-friendly asset to own if one doesn't have the bandwidth to manage it.
Right.
So, we actually divide the services we provide into 3 different parts. One we call the pre-investment. So, that's to do with asset selection. That's to do with negotiation of the price and terms with the seller. We do valuation reports, coordination with IPCs, legal. So all of that comes into the pre-investment part. Now, during the, you can say, fundraising period, we, provide regular updates. We provide documentation. We have a team of CAs that help understand, what are the financial implications and things like that.
Right.
Now, post the investment consummation, or once we sort of acquired the property, we have an investment dashboard which is actively sort of updated with all the tracking, performance metrics, real-time reporting. And to that end, even if tomorrow, let's say, tenant replacement is required, or let's say a problem with the property happens, for example, a DG set malfunctions or generator malfunctions.
Right.
So we essentially do it end to end. So for an investor, it's as simple as you invest 25 lakhs, get monthly rental and forget about it. We do everything else that is involved.
Nice. What are the performance parameters that you look at?
So, we usually target a rental yield of about 8 to 10%. Of course, you have outliers like our current opportunity is at about a 10.5.
Okay.
So we sometimes are able to find these favorable deals, of course, given the circumstances of the seller, his requirement of funds and things like that. But as a general rule of thumb, we follow a 8% to 10% rental rule. And in terms of what we are projecting in IRR, we target a 15% odd IRR at the bare minimum.
Nice.
And again, this is on very conservative basis. So on our current portfolio, we are looking to deliver above a 20%.
Fantastic.
Right, Aryaman, I think that covers a lot of the here and now questions that we had. But since you have experience with tech as well, I thought I could ask a slightly more forward-looking question. So a lot of what we've discussed about today is a little similar to what I've seen in asset tokenization. Using blockchain tokens to represent fractions of a property. So do you think that that's where this concept of fractional ownership could be headed?
So yes and no. So to understand the application of tokenization, we actually have to sort of see what are we trying to achieve by integrating that technology in itself. So tokenization currently is being explored in two different forms. So one is actually for providing that additional layer of security
right.
to the data, to the investor information, to documentation and things like that. Now, the thing is now that is a problem which doesn't require solving currently. In fact, it's not too much of a problem in itself. Of course, doing tokenization would make it all the more secure, but that level of security currently is not required. There are many platforms which provide that same layer of security. Now, the second part to it is that if you try tokenizing the, you can say, fractional ownership of the property in itself, that's a very complicated process because the sort of legal and regulatory framework under which we are doing this is a age-old framework. It's a private limited framework. Now, sort of transitioning that to tokenization is something which, yes, it might be possible in the longer term. It might make it more tech savvy, but it's something that we don't see happening, at least in the foreseeable future, in India, given the sort of current norms.
All right. I think we're pretty much close to wrapping up. But Aryaman, there's one follow-up that I thought we can't miss the opportunity of asking you, simply because we've talked so much about it. We've talked a lot about the comparative between residential yields and commercial yields. Do you find that fractional ownership, maybe internationally already has this, but in India could be headed in the direction of also incorporating residential real estate into portfolios?
To address that question, I'll just, tell you a little bit about the return profile of residential. Now, residential is not something which you buy for a yield. So residential investors are usually looking for the appreciation part. So, that's pure play speculation.
Right.
So yes, in residential, you can achieve very high returns. In fact, a lot of investors probably have achieved, fantastic returns. But at today, we are focusing on yielding assets. Now, when we, deviate from, let's say, our current outlook of focusing on core stable assets because of the current pandemic situation, and we sort of look at, more value add projects. In that, yes, residential can come into play, but the investor profile and what his expectations are might be different. We might not be targeting fixed income investors anymore. We might be targeting pure play real estate investors at that point.
Right.
All right. I think with that, Aryaman, we've come to the end of our conversation. But I must say it was quite an illuminating discussion, and I had a lot of fun talking to you. I think you kept us also on our feet while we were, learning about fractional ownership and taking the discussion forward.
Thank you. Thank you so much.
No, absolutely. And thanks a lot, Akshay and Yash, for having me and giving the platform to discuss MYRE Capital in further detail.
If you enjoyed this conversation, be sure to follow Concrete Conversations on Instagram to know more about upcoming episodes and for some behind-the-scenes content.
For more deep dives into the world of Indian real estate, stay tuned for more Concrete Conversations.